Welcome to today's installment of Regional Report, a GPEC Virtual Series. Now, during this webinar, our experts will be presenting their insights into the current economic trends shaping our region and nation, as well as their projections for 2025. Hello, everyone. My name is Eric Sperling. I am the CEO here at STN, and if you're unfamiliar with STN, a little bit about us, I encourage you to head to stntv.com. All of our shows and segments are dedicated to local leadership, actionable solutions, and community growth. We've done a number of segments with GPEC CEO Chris Camacho that you can find there. Again, encourage everyone to visit stntv.com if you hadn't had a chance to check out our local leadership content just yet. Some housekeeping items if you are here for the first time as well. Today's webinar is being recorded and will be shared on the GPEC website and social media. Now, all audience members are muted and without video, but you may submit questions using that Q&A feature at the bottom of your screen. Now, we may not be able to answer all those questions due to time constraints, but we will do our best. Now, I'd like to welcome and briefly introduce you to our experts before we dive into their presentations. With us today, we have Michael Gregory. He is the Deputy Chief Economist and Managing Director for BMO Capital Markets. He will be giving insights into the national economic outlook for the year. Kristen Stephenson, Senior Vice President of Research and Analytics for GPEC, is back with us. She will present on our regional economic outlook. And Tina Tamboer, Senior Housing Analyst for the Cromford Report. She will give us the rundown on local housing market trends. So let's start with Michael. Michael is part of the team responsible for forecasting and analyzing the North American economy and financial markets for BMO. He spent his career working in either economics or financial markets research for firms on both sides of the Canada-U.S. border. Prior to his current role, Michael headed up the financial services analysis team at the Bank of Montreal, focusing on regulatory and industry restructuring issues before shifting to BMO Capital Markets Economics in 2004. Michael, thank you so much for being here. We're excited to get to your presentation. So with that, we'll give you the floor.
Thanks, Eric, and hello, everyone. All right, so I'm going to talk briefly about the outlook for the national economy, and the title of my talk is New Year, New Risks. And important thing about, we do have a lot of risks facing us right now for the outlook. And if you just go to the first slide, please. And a lot of those risks are falling out from the events that have happened over the last little while. Yesterday, we ended up with a new administration, and a couple of weeks ago, a new Congress led by the Republicans. And we're going to get some shifts here in economic policy. We're still not sure exactly what direction those shifts are going to be, but given what we saw during the campaign and what we've heard since, and even little hints of it with some of these wave of executive orders that were signed yesterday, we see things unfolding that'll be both positive and potentially negative for the economy. Obviously, you cut taxes. That's a positive thing for growth. As everyone knows, comes January 1st, 2026, our tax rates are scheduled to go up. Of course, they won't. So as a minimum, we're expecting this current Congress to extend the expiring 2017 tax cuts. But as we know, during the campaign, there's talk about even more personal and corporate tax cuts. We got hints of this yesterday. Lots of deregulation coming down the pipe. A lot of the announcements yesterday dealt with the oil and gas sector. Nevertheless, these are all positive for growth. On the other side of that, though, we've got factors that are a little bit negative for growth. First of those are tariffs and potential retaliation from other countries, deportations, which were hinted at against yesterday. But again, we'll have to see how these measures actually unfold. And potentially, when the Department of Government Efficiency finally makes its report and recommends some major cuts to government spending, that will also be a sort of drag on growth. So we see both of these things for the outlook right now until we get more clarity, kind of offsetting one another, both for the economic outlook and also for the outlook for the equity markets. However, running through on both sides of the ledger here, there are some common themes, as you can see here. And we do think there's and we sort of count on these are more likely happening. One, larger budget deficits, faster inflation, and because of that faster inflation than would otherwise be the case, potentially higher interest rates than would otherwise be the case, and finally, a stronger U.S. dollar. So we're not sure exactly where things are going to land, but what we can focus from now on, what we do know what's going to happen, and or at least have a good chance, a good reckoning of what would likely unfold. Go to the next slide, please. Well, the Fed has been cutting interest rates. They began in September of last year. They cut quite aggressively, 100 basis points through the final 3 meetings of the year. But they signaled last month that they're going forward, they're going to slow down the pace of rate reductions. They're still going to cut rates, but not as aggressively as 100 basis points over 4 months. And the reason why they're going to slow down that pace of rate reductions, number one, is because they've cut already meaningfully, and they've moved a lot closer to what they consider to be the neutral rate. The Fed policymakers believe low 3% range is probably, with inflation at 2%, is where things will probably settle down over the long haul. And therefore, we moved a lot closer to that level. And as you get closer to that level, it's incumbent upon the Fed to start moving just a little bit more carefully, hence, not cutting rates as quickly as they did at the end of last year. And let's face it, the economy is still doing okay. Labor markets are still doing okay. So there's no urgency to cut quickly. But the more important factor, I think, why they're moving slowly, if you go to the next slide, please, is because inflation is proving to be stubborn. Yes, we've come down meaningfully from those 40-year highs that we were witnessing during the summer of 2022. And we've come down again meaningfully, but last few months things have kind of leveled off a bit. We're not getting the kind of further gains that we probably would have expected if the economy was a little bit weaker, quite frankly. But again, the Fed really doesn't want to see the economy get much weaker than it is right now. In fact, it's very happy with the kind of pace of economic growth we have right now. So inflation is proving to be a bit stubborn. Both the CPI and the PCE price index, that latter is the one that the Fed pays most attention to, and it's doing a little bit better than the CPI. But again, we're not quite at 2%. The important thing to keep in mind, number one, the Fed knew that that last mile to 2% was going to be a bumpy road. Those were Fed Chair Powell's words exactly. More importantly, the Fed has said, listen, if we are going to cut rates further, we first want to see a little more improvement on the inflation front. But importantly, we do think they will continue to cut rates. And the reason for that, if you go to the next slide, please, is labor markets themselves, while still pretty sturdy, have slackened. They have slowed. The unemployment rate has moved up quite meaningfully from the lows we had, a year or two ago. And in fact, for some of you may be familiar with something called the Somm rule, named after economist Claudia Somm. And she observed that whenever the unemployment rate moves more than 0.5%, when you compare the current sort of 3-month average to the low over the past year, the US economy has always been in a recession. It's been a 100% accurate leading indicator. And lo and behold, that Somm rule was triggered temporarily. And that was sort of rang some alarm bells for many folks. Now, the US economy is not in a recession by far. But nevertheless, it gave a sense of just how much the labor market has in fact slackened, despite the fact that the unemployment rate is not far off where the Fed believes things will settle over the long haul. Meanwhile, job growth itself has slowed quite markedly. In fact, for a couple months there, we were actually seeing the household survey of jobs. Actually, we're showing a contraction. Payrolls were still kind of advancing, even with the expected downward revision, that benchmark revision that happens once a year. We know it's going to look like, so we're able to sort of at least put a line for it. But rarely well, in fact, it's only the case that job growth actually contracts when we're around a recession. But again, we're not at a recession. But it just emphasizes yet again just how much slack has unfolded in the labor market. And the Fed has basically drawn a line in the sand and said, we do not need further weakening in the labor market to bring inflation down. And therefore, we're not encouraging it. We would like to see it, and therefore, that is fundamentally the key reason, along with further improvement in inflation, why we think they will continue to cut interest rates this year. Go to the next slide, please. We happen to think that they're going to pause for a little while here. Again, waiting for the inflation improvement to sort of unfold. Hopefully, the labor market doesn't weaken, the economy remains solid. Plus, there's a lot of uncertainty about government policy, particularly on the tariff front, which can be inflationary. So, better just to be a little more cautious. We think the Fed, by the middle of this year, will be eager to cut interest rates again, and we have 3 interest rate reductions for this year and a couple more for next year, getting the policy rate down to that low 3% range, which we believe and the Fed believes is where the neutral level is. For long-term interest rates, though, we don't think they're going to fall as much for the simple reason that there is a little bit more inflation risk out there because of the stubbornness on the ground now, but also there's this little fear about potentially if we get a lot major tax cuts or if we get tariffs, both of those could be potentially inflationary. And on top of this, we've got a pretty big government deficit that looks like it's only going to get bigger. And from a credit worthiness standpoint, and we've seen two of the three major credit rating agencies have already downgraded the credit rating of the U.S. government. So to us, that tells us that we will see some decline in long-term interest rates, but they'll be a little bit stubborn. Still, 10-year treasuries above 4%, which means 30-year mortgage rates likely to remain, at or slightly above 6%. Next slide, please. The good news here, though, is that we will get a little more lift for the economy, even as the Fed sort of cuts a less aggressively than they did last year. And that stimulus from the Fed easing will provide that economic lift. At the same time, yes, the stock markets have been a little bit wobbly lately, but we do think as the economy continues to perform well, and we get the rate cuts and we get government policy that clearly leans more towards a pro-growth agenda, that will be again a positive for the stock market. We'll be hitting those record highs yet again. And that boosts the economy from that perspective. Also, we do have those three major pillars of industrial policy that were passed under the Biden administration, on the infrastructure front, on the chips manufacturing front, but also in the Inflation Reduction Act, really, which is kind of a silly name for an act because it did everything but actually, I think, dampen inflation. Nevertheless, a lot of measures in there in terms of supporting investment for clean energy and things like that. Now, those first two bills I talked about, they were passed in a bipartisan fashion and will likely be retained. Obviously, we saw yesterday some of the measures that were contained in the IRA have been rolled back. But importantly, a lot of the support for investment, for manufacturing jobs and activity in those spaces were not rolled back. So to me, this provides yet further support for the economy. And finally, the household sector. 2/3 of the economy is consumer spending, and households have a very strong balance sheets in terms of debt to income, in terms of net worth to income. True, lower income cohorts, are feeling the stresses of, relatively high interest rates and still, stubbornly high prices. But nevertheless, for the consumer sector in aggregate, very well positioned to take advantage of when interest rates fall and we get a little more lift to consumer spending. Next slide, please. Finally, and this is my last one. We have the Fed cutting interest rates. It's helping the economy. The economy actually performing a little bit better than the long-term speed limit. Growth we're expecting, slightly above 2%, and the sort of the long-run trend for the U.S. economy is somewhere slightly below 2. So we're actually growing a little bit faster than we normally would expect over the long haul. Yet, we do think we'll get continued disinflation. Inflation will come down. The reason for that is because we're getting still a good support for productivity growth, which allows the economy to grow a little bit faster than its sort of potential over the long haul without creating kind of inflation. And yes, inflation is not coming down as quickly as you would normally seen in other cycles. But on the other hand, we're not seeing a rise in the unemployment rate, which would have predicated that improvement on a rapid improvement on the inflation front. We think getting back to 2% inflation is not going to be a 2025 story, probably a 2026 one, but that's okay because the unemployment rate is going to remain pretty low. The economy is going to continue to perform well. And as Dr. Pangloss said in Candide, this truly is the best of all possible worlds. And I'll leave it at that for now. Thank you.
All right, Michael Gregory, thank you so much. And a reminder to everyone watching this, you can use that Q&A feature at the bottom of your screen if you have questions for Michael. So Michael, stick around. We're not letting you off the hook yet. We'll get to some Q&A a little bit later in the program here. But now let's bring in Kristen Stephenson. We're gonna regionalize this. Kristen is GPEC's Senior VP of Research and Analytics. She's been with the organization for almost 19 years. Her leadership in innovative research programs, including community partnerships and market analyses, supports GPEC's mission of attracting quality businesses and advocating for Greater Phoenix's competitiveness. Kristen, Kristen, after hearing what Michael had to say about our national outlook, let's bring it in local here, and we'll turn the floor over to you.
Thank you. So we can go to the next slide, talking a little bit about the greater Phoenix economy. Just to set the stage, our economy is looking very similar to the national picture, except a little bit better. So I'll get into the details on that. One thing that I do want to highlight is our current GDP. This data lags a little bit. So the most recent data that we have for greater Phoenix is actually for the end of 2023. We'll get 2024 data very, very late in 2025. But we saw that we continued to see growth in our gross domestic product year over year, expanding by about 3%, keeping ahead of the U.S. as we've done for the last few years. You can see those lines on the chart there where we have continued above the U.S. We do expect to see a strong picture for Greater Phoenix as we get those 2024 numbers in, due to what we've seen in the national economy. This year we saw some very solid growth in the national economy of around 3%. So we expect Greater Phoenix to do very similar when we get the 2024 data. If we can go to the next slide. Talking a little bit about wages, though, we did see, and I'll get to this in a later slide, some inflation pressures in our market. So that contributed to what we're seeing here in real wage growth. So this is looking at wages when inflation is factored in, as opposed to just looking at straight, numbers without inflation factored in. Even still, we did manage to outpace inflation in terms of wage growth. We saw about 1.5% growth in our real personal income and about a 0.6% growth in that per capita. Obviously, as we've seen more people move to the market, and we've been one of the strongest markets for people to move to, we take that into account when we're looking at the per capita personal income, so that we know what we're doing at in terms of a per person basis, not just the overall economy. We don't want to just see the overall economy growing because people are moving here. We want to see it growing because we've seen benefits for individuals here as well, which we did see this last year compared to 2022, where we did see those pressures because of inflation. This year we've gotten back on track with where we want to be, and we'll continue to keep an eye on that for 2024. However, the numbers should continue to look even better for 2024 because inflation has slowed down in our market so much. Next slide. So where I really want to dive in is Greater Phoenix employment. To Michael's point about what the national economy has been doing, Greater Phoenix has been performing exceptionally well over the last year. We saw about over 40,000 jobs added year over year in our market. And that's also while keeping an unemployment rate of 3.5%. Our total employment is now up to 2.5 million people here in our market. And this has been a very positive the overall performance for Greater Phoenix. Early in the springtime, for a number of months in a row, the Bureau of Labor Statistics releases data on how each metro is performing, how each state is performing, and Greater Phoenix was at the top of the metrics of all the large employers and near the top of all sectors, all metros. For a number of months back this past spring, we were the best performing market. It wasn't just we saw the largest decrease in our unemployment rate, but at the same time, we also saw very substantial employment growth. We saw our labor force growing. So this was one of the hottest markets back in the spring. It continues to be a market that is performing very solidly above average. Next slide. So where we can see this breaking down into our industries, the largest industry in Greater Phoenix is actually our professional and business services sector. That makes up about 1 out of every 6 jobs in our market. The other sectors that we've seen very strong performance in, healthcare continues to dominate our economy in terms of growth. If you've tuned into this webinar in the past, you've heard me say this, I'm going to say it again. Prior to the Great Recession, our healthcare sector employment was around 8%. We're now getting close to topping about 13 to 14%. So we've seen all of our sectors have grown that one has grown faster and now makes up a larger share. The other thing that we also see now is where construction and manufacturing are really similar sized. I expect that trend to continue as we see a lot of these big manufacturing projects come online. We'll continue to see some growth in our manufacturing sector here. So what that really means is we've seen a strong growth in our base industries. It has allowed us to be a more diversified economy than we were, say, pre-Great Recession, which allowed us to navigate the last few years better than a lot of other markets because we had taken the time to put that diversification into place that allows us to see this growth. We've seen growth in all sectors, like I said, but things like, retail trade may make up a slightly smaller share of our economy now. Things that are predicated on consumer growth make up a slightly smaller share of our economy now. So we see that Greater Phoenix has put itself in a very stable position going forward. Next slide. So where we're seeing that in terms of the job growth forecast this coming year, we're expecting to see this particular forecast is from University of Arizona, but most forecasts reflect a very similar number, is we're expecting the Greater Phoenix job growth to be around 2%. So again, slightly outpacing the U.S. And pretty similar to what we're seeing in Arizona as a whole. Greater Phoenix makes up about 70% of the state's economy. So where Greater Phoenix goes, Arizona tends to go. So we'll see that about 2% growth rate in Greater Phoenix, over 2024 to 2025, and then again from 2025 into 2026. So a very positive market for us going forward. Next slide. And then inflation. So as we mentioned earlier, inflation has been a cause of concern for the U.S. as a whole, talking about what's happened in Greater Phoenix and how that's impacted us. We saw a peak inflation rate in 2022 of 13%. That's changed year over year, looking at the Consumer Price Index from Bureau of Labor Statistics. Compared to 9% for the U.S. However, since that time, we have seen those numbers fall off. So you can see the red line on here is Greater Phoenix. The black line is the U.S. average. So as you can see, that kind of that bubble in the middle, we peaked just slightly after the U.S., but a little bit higher than the U.S. But since then, our story has been very positive. We have come down. We matched the U.S. economy in August of 2023. And ever since then, we have fallen below the U.S. average. So we have about 18 months now of sustained inflation rates that are below the U.S. average. And you can see even prior to the pandemic, prior to the run-up in inflation, we tended to trend a little higher than the U.S. anyway. The Bureau of Labor Statistics started measuring our data on a bi-monthly basis starting in 2018. So really, we've got about 5 solid years of data to look at now, which is a good trajectory and time frame to look at. And we saw Greater Phoenix we saw little blips below, but generally just slightly above the U.S. Now what we've seen, as I said, over the last 18 months is a sustained below the U.S. average and below a lot of other major markets. Of the 20 or so, 25 markets that are tracked on a bi-monthly or monthly basis for their inflation, this last month, Greater Phoenix actually had the third lowest year-over-year inflation at about 1.6%. We were just only ahead of Houston and Riverside, tied with Tampa. All of the other major metros have seen their inflation rate continue to stay a little more sustained above Greater Phoenix and in a lot of cases above the U.S. average. So this is a very positive thing for us. That doesn't mean that we don't have to still deal with some of the issues that we've seen. When you look at inflation, it doesn't necessarily mean prices are going down. It just means they're increasing less fast. So now we've seen these return to the types of numbers that we want to see, the below 3%, the below 2%. And at the same time, as I mentioned on the previous slides, with the job growth, much like the federal economy, we've seen that inflation rate come down. At the same time, our economy has continued to perform very well with the continued growth in our labor force, in our workforce, and especially in our case, that low unemployment rate. With our unemployment rate being at 3.5%, it means we're below the federal average, which has been hovering just above 4%. And we've only seen that come up slightly from, low sub threes about a year ago, now up to these 3.5, which is a very healthy spot for our unemployment rate to be in, kind of along with our inflation rate at the same. So this is what we want to see continuing in our market into the future. If we can go into the next slide. So this is where we have seen some of the pressure, though, on our market is in the cost of living index. Previously, prior to this run-up in inflation, especially back into the early 2000s, even into the 2010s, we typically saw our cost of living below the national average. So what we're looking at here is the national average is basically indexed to 100. Anything below that means that it's cheaper than the U.S. average. Anything above that means it's more expensive than the U.S. average. And we typically ranged, 96 to 98% of U.S. costs prior. Now we tend to come in above the U.S. average. So this last reading through third quarter of 2024, we were about 7% above the national average. There are certain factors driving that. So the composite index looks at everything, and you can see the breakdown of how each category factors in. And the one that really continues to put upward pressure on our cost of living is that housing index. I know Tina will go into a lot more details on what that makes up. But, in terms of what we're seeing from the cost of living index, we're at about 116% here. So 16% more expensive than the national average. There are some positive factors. We see our healthcare continue to stay below the U.S. average. And even things like, our miscellaneous goods, all that stay pretty comparable to the U.S. average. So where we're really seeing that pressure is in the housing sector. The other thing that we like to look at is how we compare to our neighbors. The good thing for us is even though we've seen our costs go up, a lot of our competitor markets have also seen that reflect. So you see, Denver, Salt Lake, et cetera, they are more expensive markets than we are. And we're still very well positioned against places like California, where it's extremely expensive to live. So we'll still see a comparative cost environment compared to some of our metro area, our pure metro areas. But this is something that we want to keep an eye on because the inflation rate did have the effect of pushing this up. And now it continues to remain above the national average cost. And next slide. I think so I will turn it over back to Eric. Thank you.
Thank you, Kristen. What a perfect segue as we bring Tina into this conversation, right, to talk about the housing market. Again, a reminder, we have an incredible audience with us this afternoon, close to 400 participants. So if you guys have questions, please use that chat feature at the bottom of your screen there. And if we have time, we'll get to some of those questions. All right, Tina, Kristen kind of set you up there. Tina has 20 years of experience in the title and escrow industry. She spent the last 13 years working on the Cromford report as an independent residential housing analyst. I think you've got a really great slide ready for us to go. I'm going to kick this over to you, and then we're going to discuss the housing market.
All right. Well, we're going to start off on the next slide with our mortgage rates. And so needless to say, the housing market has been on quite the roller coaster with mortgage rates since 2022. Pretty much since September of 22, we have seen them range anywhere from 6% all the way up to 8%, and then back down to 6%, and then back up to. It's been, to say we have trust issues with mortgage rates is an understatement. So trying to predict them, I think even national analysts out there are frustrated and reluctant to even try to predict where mortgage rates are going to go in the future. Case in point, I think Housing Wire has a prediction of anything from 5.75 all the way up to 7.25. So either way, they are going to be right. So anyhow, coming in onto the next slide, what happened in the most recent case that caused mortgage rates to go up, I believe it was when the Feds announced a couple of things in the press conference, but specifically they stated not only were they going to be dropping the Fed funds rate, which generally people think means the mortgage rates will come down, but then the second sentence said, we will be continuing to reduce our securities holdings. They have 92% of their securities holdings are in treasuries and mortgage-backed securities, whether that's commercial or residential. So that means they're going to be selling bonds. And when they do that, it increases the supply of bonds and causes rates to go up. And that's what actually caused our rates to go up over the fourth quarter. So in contrast, though, they did throw us a little bone out there. Basically, the feds were like, everything's, pretty much going along as we would hope. Inflation, they weren't too concerned about. Wage growth, they said, has slowed. And then they said GDP is going well. Consumer spending is resilient, blah, blah, blah. And then activity in the housing sector has been weak. That's all they had to say to us after basically 2.5 years and going on 3 years of extremely low sales volume. Needless to say, the housing industry as a whole, with resale and new home, is pretty much at their bare bones. So in the next slide, you're going to see, in the next slide, there we go, our accepted contracts. So every week we track how many contracts were accepted in the previous week. This is our spring season. As you can see, when the rates go up above 7%, that is generally not good for overall demand. We will still see a nice boost in demand over the springtime, but how high that boost goes depends on how long we stay above 7% in our mortgage rate. So as you can see, we're shooting up a little bit now. We're hoping to at least get to 2024. But when you look at all of those years, all of those faded out years, you can see that we are coming in on a very low bar to get above. So in the next slide, what are we looking at coming into 2025? What kind of marketplace is it? So how high that goes up depends on whether or not we're in a seller's market, a buyer's market, or a balanced market. And so on our indexes, 100 is balance. So 90 to 110 is generally our balanced range. If you go over 110, you're in a seller's market. Below 90, you're in a buyer's market. And when you are in a balanced market, we expect to see prices go pretty much flat and follow the rate of inflation. So on the next slide, you'll see where we're coming in at 91.3. We're in a balanced market, but just barely. We're pretty much teetering on buyer's market. Once again, supply did start to come down over the last 30 days. Demand has gone flat on our index, but that supply line popping down has actually improved our market index, because just in November and December, we were actually in a just a little baby mild buyer's market. And on the next slide, you'll see the daily tracking of this index showing how we were just in that buyer's market for a couple of months and bounced right back. And we have a couple of things that happened that really helped out the marketplace. But still, this is not meaning that we're going to see any big, bold movements in price. It's just going to be whether or not the buyer's experience is going to be shifting. So next slide. Over the course of 25 years, you will notice that this index doesn't go below 100 very often. So buyer's markets are far and few between in Greater Phoenix. And as you can tell, it's certainly not anywhere close to the granddaddy of them all, the 2006 to 2008 buyer's markets. And oftentimes you don't see huge, big, bold movements in price. They have to be there for quite some time to see any massive drop off. And of course, you'd have to see the lending industry collapse like it did in 2008, which nobody is predicting at this stage. But if you are talking with somebody who is waiting for rates to come down before they buy, even if they can shoulder the rates of today, I can't guarantee that they're going to have a buyer's market with it, because oftentimes by the time those rates get down, we start to move out of those buyer markets and start to see seller markets once again. And with seller markets, you get sales prices moving faster than the rate of inflation over the annual measurements. So on the next slide, what is the rate of inflation? Just a reminder, the most recent CPI report was 2.9%. The PCE, as Michael pointed out, was, I believe the last one was 2.4, I think. And so somewhere in the middle, right around the mid twos, is where we would expect our appreciation rates to be. So where are they? On the next slide, we've got our median at 4.8. What? That doesn't seem like it's really going in line. So I want you to think of the median as of the buyer's budgets. 50% of our sales are above that, 50% of our sales are below that. But when you look at the dollar per square foot on the next slide, that is what you get for your budget. So up 6.7%, way over the rate of inflation. So can't wait for the Case-Shiller Index to get a hold of this when they release theirs. But let's talk about what's happening to price, that it's going in the opposite direction of where we would expect it to go in a balance and even a buyer's market. So when I take out one segment of our marketplace over $1 million, on the next slide, you will see how that line changes immediately. So back to 2.9%, conveniently, right around December's rate of inflation. Don't always get that. But you can kind of see how the luxury realm has definitely affected the overall appreciation rates for the Valley. So on the next slide, you will see when we break down our appreciation rates by price range per square foot, there's not really a whole lot of excitement going on per price range, all the way up to $1 million. Actually had slightly higher, 3.3% in the 1 to 1.5 million, and then a whopping 7.4% appreciation in the market over $3 million. So what happened there? Is it, you know, if all of these are pretty much flat, except for a very small part of 1.4% of our whole marketplace, what is it? So on the next slide, you will see the market share of the luxury market picked up in December. And so far it is continuing through the first half of January as well. It's even more heavy towards the top end. So what's essentially happened is you've got a data set that's top heavy, and it's pushing all of your averages up, when most of our sales, which are under, 90% of all of our sales are under $1 million, most of those appreciations are flat and following along with what we would expect from 6 months or so in balance or buyer market territory. So next slide. So here's what I was discussing earlier when the Fed said that sales have been weak in the housing market. I'd say that is an understatement of the year. They are definitely sitting at a bottom, which makes me feel very confident or hopeful in a way that we have finally gotten down to the bare bones of buyer demand. They are just less focused on the mortgage rate. They're less reliant on mortgage rates in order to purchase their home, which means that once those mortgage rates start to edge down, we will definitely see that number start to grow, and hopefully a recovery in sales volume happen for the housing industry. But that drop from 2021 to 2023 is well over 37%. But year over year, it's only down 1.7%. So that's showing us that we've got a stability, but it's still extremely low for the size of our metropolis here in Maricopa County. Just, I'm sure Kristen and Michael can agree that we have grown exponentially since 2005 through 2008. So that is an extremely low number for us. So on the flip side, though, on the next slide, you'll notice that that's not the case for sales over $1 million, though. They're going gangbusters, up 14%. And so again, that's going to have wreak some havoc on our appreciation rates here in Greater Phoenix, and having that perception that home values just continue to rise and rise and rise and rise, when it's really the changing of our makeup and our economy, and a luxury division that's starting to really grow in Greater Phoenix. So moving along. That's our contract ratio. Contract ratio on this map is basically comparing what's active versus what's under contract. And if you have a lot active and just a few under contract, then that could mean that you're in a cold part of the valley. That's all your blue. But the orange there, so those little orange spots, which if you go to the next slide, those little orange spots, those are the little glimmers of heat. There's a few coals in our campfire here, just barely hanging on. And Tolleson, a little bit of Ahwatukee, a little bit of South Tempe. But if you looked at this map, you would think, oh gosh, this is terrible. We're never gonna get out of this. But if you now target market, on the next slide, you'll see that the 300 to 400 range, just as an example, you'll see it light up with heat. So it really depends on the price point, the area that you're shopping, as to whether or not you're gonna see a cold market, whether or not you're gonna get, be able to drill down on price. A lot of these mid-range price points, especially first-time home buyer ranges, are still quite competitive in many parts of the valley, especially the Southeast Valley and the central areas. You can see Moon Valley there as well. On the next slide, one surprising piece you might not expect, the condo market over $1 million is also seeing a frenzy, not everywhere, but just in these 3 zip codes. North Scottsdale 85255, 34 active, 54 under contract condos. And Old Town Scottsdale 64 active, 96 under contract. and a little bit of Biltmore, 12 active and 8 under contract. This some of these are resorts, especially in Old Town, that is the Phoenician. And so we have these little pockets that are definitely going against the trend. So on the next slide, here is your market summary. Is this good or bad for sellers? It's kind of complicated. Yeah, it's nice to see prices rising, quote unquote, but most are going to find out that that's not them, unfortunately. Prices have remained flat, not just for the last year, but really for the last couple of years. In fact, you want to have owned your home for at least 3 years or more to see any kind of, significant appreciation in your home at this stage. But everything is pointing towards buyers right now. It's a good opportunity for those not so perfect buyers, those that have contingent sales that they have to sell their home, their previous home before buying another. Maybe they're using down payment assistance. Maybe they want to do assumptions. Maybe they're doing something creative. This is the market for them, because once these rates come down, most likely they will get kicked to the curb again. So with that, on the next slide, I just want to thank everyone for having me, and I'll turn it back over to Eric.
Thank you, Tina. The first time I saw a slide with a section that had "what the frick" in it, that was awesome. We are
Glad
going
you
to
noticed that.
Yeah, there wasn't a lot, but I saw it.
that was used in 2021.
All right, we're going to get to some of those questions now. We appreciate everyone sharing their remarks. We've got a few live questions coming in. Apologies as I read this cold sometimes. I guess we'll start with Michael. We got a question for Michael here. What are your thoughts on the current earnings season? How is it shaping up in your view? And this viewer also loves the Voltaire quote, so they picked up on that. Very astute viewer there. Michael.
Well, I do think earnings, they're looking good. I mean, the economy is growing. That's important. Costs growth has come under rein a bit here compared to what we were seeing previously. It's getting harder and harder for businesses to raise prices to the same degree they did a couple years ago. So the focus now has been pushing on to stabilize margins, to improve margins by looking at the cost side, boosting capital spending to boost productivity, renegotiating lower contracts, whatever the case may be, to try to keep those earnings growing. And let's face it, as long as consumers keep buying, and we expect that to happen as interest rates continue to drift down, more importantly, as jobs continue to be created, that will provide that backdrop for good earnings growth in corporate America.
All right, thank you, Michael. Let's bring Kristen in for this question. And Kristen and Tina, quick. I just have a personal question. Are we still? I remember at one point we were saying close to 200 people a day in average were moving here. Is that number still accurate, or where are we at with the number of people moving here?
Yeah, I mean, we saw a little bit of a slowdown over the last year or so in terms of people moving here. But when I say slowdown, it doesn't mean people aren't moving here. It just means we were top market before. Now we're just, top 10 market. But yeah, so we are still seeing a number of people move here every day. Migration is very strong. That's actually what makes it really interesting too, with the job numbers, the unemployment rate that I talked about too, is we're also seeing just our overall market grow. And then that has led to that economic growth as well.
Okay, so when we're at the dinner table and we want to sound smart, we can still say about an average of 200 people a day are coming here. Okay, got it. On that note, Tina, this question just came in, and we just saw your presentation, so I think it's perfect timing. With all those metrics, what is the one metric that you'll be watching the most in 2025?
Mortgage rates.
Okay. Yeah.
I think all eyeballs are on mortgage rates. And I'm also waiting to see what our incomes turn into, because of course, if mortgage rates stay high, as we see our prices remain flat, then if those incomes start to rise, then we'll start to see the affordability start to fall back in line. So those are the things for affordability that we need to see. But I'm also watching the concessions to the buyer. Those are the things that you can't see underneath the line. What percentage of sales right now are at about 51% last month sold with some form of seller concession to the buyer to the tune of like $10,000 is the median, which are buying down the rates and continue to do things like repairs, all kinds of different ways that keep those prices high, even though we might be in a slight buyer's market.
And I have a follow-up question I wrote down regarding your heat map there. I know we were talking about, sales over 1 million, close to 14% increase. Is there, any hyper regional activity there that you focus on? Is it Scottsdale? Is it Chandler? Where those numbers are?
Well, what I really linked it to, frankly, was in December, if you remember, Bitcoin went crazy.
Mm,
Remember that? And so we've
mhm.
been able, since 2020, since the Bitcoin craze or the cryptocurrency craze, we've been able to tie pushes in the luxury realm. When those areas are shooting, we tend to see a lot more luxury sales as well. So Bitcoin in December hit over 100,000, and also the stock market went crazy. So right after the election, we had a lot of people who were waiting after the election to see what was going to happen. And with both of those going in the positive direction, that had a positive impact on the luxury market specifically.
Got it. Kristen, a question coming in for you. What are your insights on potential impacts to the Arizona and Greater Phoenix economy in light of the new U.S. administration signaling 25% tariffs on Canada and Mexico?
Yeah, so from the tariff perspective, obviously, with things still being newly announced, we are waiting to see how that shakes out, what actually happens. There's been different numbers thrown out there in terms of what it could be. So we won't know the full impact on our economy until until those agreements are finally put into place. We do want to encourage uh, free and fair trade policy. Mexico and Canada, for example, are our two biggest trading partners, but we won't know the full impact of that on our economy until those agreements are put in place.
Right. All right. Michael and Kristen, both of you have touched on this, but I'll ask you follow up. Michael, we'll start with you. What are your predictions for the labor market in 2025, particularly regarding workforce trends like remote work, automation, or skills gaps?
Well, first, I think the labor market's going to remain strong. We're looking at, and from a national perspective, an unemployment rate, the low fours, 4.1, 4.2, 4.3, bouncing around in that range. And that historically is quite tight. And as a consequence, I think we're going to see continued investment by businesses, which we've already seen in capital to try to boost productivity. We're looking at productivity rates now that are growing upwards of 2% on a year-over-year basis, which is well above what historically recently they've been. And so I do think that bodes well for income growth, because ultimately, you can have a lot of job growth, but you want to see that income growth. It supports housing, it supports consumer spending. So if you're getting a solid growth in jobs, a tight labor market, relatively speaking, and you got that productivity gains, it's like a win-win-win in terms of consumer spending.
All right, thanks, Mike. Same question for you, Kristen. Labor market trends in 2025.
I think what we'll see in terms of labor market is some upskilling, especially, in the greater Phoenix area. As I mentioned, we've seen a lot of growth in our unemployment, and that's holding steady in our unemployment rate means that we need, in some cases, upskilling to fill the gaps. We are also see, as we continue, we were talking about the population coming here, we'll see that fill in a lot of our labor market as well. I think generally, though, it's going to be a very, our market is going to continue to grow. We know this based on what we've seen from, companies announcing here over the last few years. Those projects are really starting to come online, which means those people are going to be hired, this year, next year, and into the next few years. So we know we're looking at probably a strong labor market that will continue to be a little bit tight. So there are some opportunities here for upskilling and growth.
So, Kristen, as we're talking about trends here, and again, this is another question that I had pop up as I was watching your presentation, and you had that one slide that showed all the different sectors and where the growth was. Where does the kind of the gig economy or the side hustle economy fall into that? Is there data around that? Are we going into different sectors?
Does fall into different sectors, depending on what the, you know, gig economy is, depending on what the person is doing. So it's a little bit hard to quantify like the gig economy separate from the overall economy. One thing that we have to work within, getting a little bit nerdy for a second, is the framework of, you know, the federal government has how they classify jobs. And we know in this changing economy, sometimes that means that we're kind of having to look at a more anecdotal version of what the data is saying, versus where it's, you know, put in its particular buckets.
Yeah, a lot of people looking at upskilling versus just getting a side hustle or a gig job there. Question coming in, let's see, Tina. What do you anticipate the impact of the LA fires will be on the housing market and population growth for Phoenix?
I get that question quite a bit these days. I think it's a little early to find out if there's any permanent benefit to Greater Phoenix. In the past, it's not been uncommon to see every time there's something that happens in California, whether it's a mudslide or an earthquake or a sinkhole or fires, we've always seen some contingent of Californians moving here. But we find out much later, as Kristen said, we get these numbers a bit late after the game is over. But in general, we can expect to get some, but they used to come here, and because our cost of living was so much lower, and they're finding in some cases that the cost of living here is just as high as parts of California. And that might push them to other places of the country, like say Las Vegas or even Idaho or other parts that they feel that may be able to accommodate them a little bit more. But in general, you know, it's hard to say how many people will come here and stay here versus how many are going to come here temporarily and then move back.
Speaking of people coming here, question for Kristen, and Michael, I'll ask you this question too. With such a hot job market in Phoenix Metro, what percentage of jobs in 2025 do you foresee will need to be filled via relocation?
You know, it's hard to quantify a specific number, but I will say I expect jobs to be filled in some part by relocation. If you look at the economy, you know, we say 3.5%, but what does that actually mean in terms of unemployment? Generally, if we're below, you know, 3%, 2.5%, we're essentially at full employment. You're just seeing employment churn. So the fact that we're at about 3.5%, you know, between 3.5% and 4% in Metro Phoenix in Arizona means that we are going to need people to come here to fill those jobs, you know, in addition to the normal churn that we would see in our market.
Michael, anything you want to add to that?
Yeah, sure. Just very quickly, when you look at all the states and you look at all the projects that have been announced in sort of the manufacturing space, either tied to the IRA or tied to the Chips and Science Act, in terms of economic exposure, I mean, dollar amounts, Texas is number one, but in terms of economic exposure, Arizona is at the top, which means Arizona is going to get a lot of growth going forward, and the demand for the skills to accommodate that growth is going to be there. In fact, you see a lot of anecdotal evidence from the companies on the ground now. They're saying we have to slow it down a little bit because we don't have the skilled workforce. We don't have the people we need. So, I mean, if anything, that low unemployment rate, which the state has and the local area has, is very much, it's a nice thumbs up to say, you know, how strong the economy is, but it's also a governor. It's a restriction on growth because we just simply don't have the kind of the extent of inward migration we actually need to fill all the jobs that are coming down the pike.
Can I
Thanks,
add just
Michael.
one thing to that too, is where we were talking, I kind of touched on it earlier with upskilling, to Michael's point, where we have seen a lot of those jobs and companies come in, is our university system, our community college system, and our business system has been very hands-on and paying attention to that, so that we are getting the training programs put in place we need to meet those future workforce demands as well.
All right, speaking of training, Kristen, coming in here, how will advancements in technology and AI impact economic development and reshape industries in the coming year?
AI is such an interesting trend. It has changed things so much, but I see it just, it's going to be another tool. I mean, if you look at how our economy, how our labor force has changed over, you know, 10 years, 100 years, whatever, we saw how much, you know, the Industrial Revolution changed how our economy functioned and moved into a manufacturing society. What we're at right now with AI is very similar, where where we will see a change in how people do their jobs. AI will be a tool to help them do it more efficiently. So I think that will help us lead to, production gains. It doesn't mean that everybody's jobs are getting taken by AI. That's not going to happen. But we will use AI as a tool to help with productivity gains in our market. I truly believe it will hit all sectors of the economy. You'll see those gains throughout each sector.
All right, one last question coming in, and what we'll do is we'll use this as our closing question. So we'll go around the room here. And Tina, let's start with you. What do you foresee as the biggest challenge facing the economy in 2025?
The economy as a whole, or the housing market specifically?
You can stick with housing.
I think right now it's uncertainty. Uncertainty in general for the economy, because you've got some investors, and those investors work off of their emotions. And if they're uncertain about whether or not we're going to go into a recession, have increased unemployment, and so on, they're going to act in one way. And then those who believe we're going to have the soft landing, like Michael said, like the feds are trying to do, then they're going to act in another way. And what happens is when they're not all in unison, you get wacko mortgage rates, just like what we've had over the last couple of years, where they're shifting over to the stock market, then they're shifting over to the bond market. And so what happens is, once that we have more certainty than uncertainty going forward, now that we have the administration changeover, which was a big part of the uncertainty part, and more unemployment reports coming out, whether they're positive or negative, but once that trend starts to look more stable, I think we'll be able to stabilize. But I'd say the one thing that is the biggest risk is just uncertainty at this point, so that we can get some consistency.
Thank you, Tina. All right, Michael, what do you foresee the biggest challenge facing the economy in 2025? As I know you touched on a little bit, but how about you personally?
Well, sure. I think one of the really two. So being an economist, you like to keep your answers open there. But the first one has clearly be, I think, the budget deficit. We have a lot of promises that were made during the campaign. We want to cut taxes. Yeah, we want to cut spending, but the spending we cut actually affects a lot of people, which is very hard to do politically. And the deficit keeps growing larger and larger. The debt keeps growing larger and larger. And at some point, it's going to lead to a meaningful increase in longer term interest rates, which of course affects housing, affects the whole economy. The second thing, though, is a more immediate risk, is the risk of tariffs and retaliation from countries that are getting the tariffs put against them. That is unequivocal. There's no economic analysis out there that says this won't lead to slower growth and higher inflation. And therefore, I think that is a key risk we have going forward.
All right, Kristen, same question. Bring us home. What do you foresee as the biggest challenge facing the economy in 2025?
From the greater Phoenix perspective, I think it's continuing to balance that economic growth with the inflation rates. As we saw, greater Phoenix inflation rates have come down while we're still continuing that strong labor force. But it is a balance. So we need to make sure that we see that balance continue into the rest of 2025.
All right, Tina, Michael, Kristen, thank you all so much for joining us. That wraps this current installment of the Regional Report. We'd like to thank you for joining us today. We hope you found this discussion informative and valuable. We'll, of course, be publishing a recording of this webinar and blog recap to GPEC's social media channel, so keep an eye out for those if you'd like to revisit the information. Again, thank you so much for joining us this afternoon, and we'll see you next time.